Hello everyone and welcome today to today's class on working capital management. I hope you all are doing well. So working capital basically involves understanding two things. The first one is you really want to understand what is the appropriate amount of working capital in total that a company should be holding and for which account, and also how should the working capital be financed. And so if we really, before we dig deep into all of these things, but how much working capital and how it should be financed, let's just get a very clear understanding of what working capital is. So working capital, also known as gross working capital, refers to current assets used in operations. So many times, current assets, for example, includes cash, account receivable, these kind of things, right? So and we've discussed this before, that cash flows are very important for companies. So you really, in many cases, many times companies have to actually borrow cash from banks just to run their normal operations. So this is an example of working capital. If we talk about what net working capital is, that is basically current assets minus current liabilities. Also, I wanted to talk a little bit about what net operating working capital is, and we have already seen this when we were calculating, free cash flows. This is basically operating current assets minus operating current liabilities. And generally speaking, cash, account receivable, and inventory is taken, and it's from that account payables and accruals are subtracted. One thing to mention is that when you're calculating net operating working capital, in that case, marketable securities and other short-term investments are not considered current assets, and therefore they are not included when calculating net operating working capital. So next, I want to talk to you about what cash conversion cycles are. And cash conversion cycles really focus on the length of time between when a company makes a payment and when it receives its cash flows. And it basically includes the whole cycle of buying inventory and then selling goods on credit and then actually collecting the accounts receivable. So, in many cases, people actually have to borrow, companies have to borrow money to buy their inventory, right? And so the time from buying of the inventory that they eventually work on and they sell on credit, and then they get the money from the customers, that entire cycle is called, or the entire time it takes is called the cash conversion cycle. And so here you can actually see over here this diagram, right? And here you can see that, there are people are somebody's actually, a company is borrowing money. And so that's where the payables come in, and they're actually then purchasing material, right? And then that material is then converted and then sold. And then once it's sold, the cash is eventually collected. Now, this entire period of from the time where they actually, receive, their inventory, and they're actually borrowing money to buy their inventory, from that point all the way to the point that they're actually getting money from the customer, that entire cycle is called the cash conversion cycle. Now, if you look at it right over here, this is broken into two basic parts. One is the payables. Okay, so this is the amount that you have to pay somebody. This is the number of days. So let's say somebody says, okay, fine, you can borrow money to buy your inventory, but you need to pay us back in 40 days. Well, that is, your payables deferral period. And so that's 40 days, and your cash conversion period is 70 days. So that cash conversion is basically the time that you have from the time that you've actually bought the inventory till the time that you're actually, you sell it and you actually get money for selling it. So these are two, kind of differentiation factors. Now, the interesting thing about this is that in general, what you want is that the cash conversion period is made as short as possible and the payables deferral period is made as long as possible. So you want that, if you have to pay money, that you have a long time to pay that money back. And you want that if you have to receive money from customers, that you receive it very, very quickly. So these are kind of two things to keep in mind. And again, the inventory conversion period, that's another terminology that you can see on this diagram over here. This is the average time required to convert materials into finished goods and to actually sell them, right? So you have the whole inventory conversion period and then the actual collection period. So these are, some terminologies that are associated with the cash conversion cycle. So the next thing I want to talk to you a little bit about is how do you actually calculate the cash conversion cycle? And so there are three parts to it. The first one is you have to take the inventory conversion period, which I just sort of spoke to you about. And this is, taking inventory right from the beginning and converting it so that it's ready to be sold. And then you have to take the average collection period, and this is the amount of time it takes to collect money from people that you've sold goods to. And from there, you have to subtract your payable deferral period. And this is the amount of time given to you to really pay off your payables. And how do you calculate each three of these components of the cash conversion cycle? Well, these are the formulas for each one of them. And so for the inventory conversion period, you basically take inventory divided by the cost of goods sold per day. The average collection period, or also known as the DSO, you can basically what you do to calculate that is receivables divided by sales divided by 365. And payable deferral period is taking your payables and you divide it by your cost of goods sold divided by 365. So again, this is, just plugging in numbers into these formulas, but it's very important for you to really understand on a high level when we're talking about cash conversion cycles, what they're all about and why companies need to worry about them. So the cash conversion cycle can be reduced or shortened by taking certain steps. The first step is you can reduce your inventory conversion period. And basically what you can do is you can start turning around your inventory and really processing it faster. And if you start processing the inventory faster and it's ready to be sold faster, then your cash conversion cycle will go down. And something to mention over here is that, a lot of companies are also moving towards just in time because they want to reduce the amount of inventory and the inventory conversion period. And please remember that, inventory, when you have a lot of inventory, that's basically your company has its own cash stock. So the less time that you have inventories lying around in your company, the better. The second thing you can do to improve your cash conversion cycle is speed up collection. So you can incentivize your customers to pay up early, and that will really help your cash conversion cycle. And thirdly, you can lengthen the payable deferral period, which basically means you can talk to people that you owe money to and request to them that you want to pay them in over a longer period of time. Now, you should try to do all of these things without decreasing your sales or increasing costs. So what you don't want is that, you have reduced your inventory, but, you're getting orders and you're not being able to deliver. That would have is a situation where your sales would decrease. You do not want that, right? You don't want your sales decreasing. You want to reduce your cash conversion cycle, but without decreasing your sales or increasing your costs. Also, cash conversion cycles, improving your cash conversion cycles, this helps increase your net operating profit after tax. And if you improve your net operating profit after tax, as we all know, then your free cash flows improve and the value of your company is higher. So This goes to show that it is very beneficial for any company to improve their cash conversion cycle because it does impact the whole entire value of the company. Now, companies have various policies regarding the net operating working capital. Some companies have a very relaxed working capital policies, others have restricted working capital policies, and also there are some that have a moderate working capital policy. So let's talk a little bit about what all of this means. So the first thing, relaxed working capital policy. This is where a lot of cash and inventory are carried by the company, and customers are given a lot of liberal financing policies, and companies really don't take advantage of the credit provided by account payables and accruals. So it's just really relaxed. Nobody is really pushing the customers to pay up. As far as the payables go, whenever somebody's asking to sort of pay, then you pay them. There's really just a very relaxed kind of approach. And then the other alternative is a very, some companies have is a very restricted working capital policy. And here the holding of cash, inventory, and receivables is minimized. So you have very little cash, inventory, and receivables, and accruals of payables are maximized. So you want to really try and pay as late as possible your payables. And the moderate working policy is really right in between the relaxed working capital policy and the restricted working capital policy. Now, if in general, it's important to mention that safety stocks are needed. And so if you're going to be holding just the minimal amount of cash and the minimal amount of inventory in a restricted working capital situation, you do hold the risk of losing sales. And so this is therefore a very high risk strategy. On the other hand, if you're holding too much of working capital in a relaxed working capital policy, then it's very expensive. And this is going to lead firms to have, lower free cash flows, NOPAT, free cash flows, ROIC, all of these things. And therefore the value of your firm is going to go down. So generally speaking, it makes sense for companies to really have, moderate working capital policies. Now, if we start looking at cash management, because, cash is needed for day-to-day running of operations. So let's just talk a little bit about cash management. To give you an idea, usually 1.5% of a firm's assets are held as cash. And now this is not a, holding cash is considered holding a non-earning asset because, cash doesn't earn any interest. So therefore, companies generally want to just keep as much cash as is necessary to, take advantage of trade discounts, maintain their credit ratings, and really meet any unexpected cash needs. But they don't want to keep more than what is actually needed. So the way to really manage cash and to hold less cash is to use some cash management techniques. Okay, and let's talk a little bit about what those techniques are. So the first thing is, you need to synchronize your cash flows. But before I go into these cash management techniques, I also want to just mention one more thing. So the reasons for holding cash. The reasons for holding cash include, number one, transactions. So sometimes businesses, during an emergency period of time, they actually need to make certain transactions by cash. Maybe let's say banks aren't working, or there's something that needs to be bought immediately, they need cash for that reason. And the second reason that companies hold on to cash is to compensate banks for providing loans and services. So banks many times keep a minimum amount of cash that companies need to keep in their accounts. And so this is known also as, kind of just a minimum balance. And this minimum balance is kept in cash to really offset, expenses. So the banks really say, look, if you don't keep this minimum amount of cash, we're going to charge you service fees, a big amount of service fees. So therefore, that's why many times companies hold on to cash. These are the two main reasons. Now I'm going to talk to you about the cash management techniques. And as I was just mentioning, if you want to hold on to less cash, then you can do certain things. The first thing you can do is synchronize cash flows. So you can basically, you forecast, okay, when exactly you'll be needing, when cash is going to be coming in and when cash needs to be going out. And so that way you really can plan, and you won't need to keep excess cash. Secondly, you can speed up the check clearing process. And so basically what you want is that checks are cleared very, very quickly. You don't want checks lying around. You don't want the checks going, a couple of days late to the bank for clearing. Clearing generally takes a couple of days anyway. So you want to make sure that as soon as you get a check, you send it into for clearing as soon as possible. Next is using float. And so here, again, what you want to do is you want to try and speed up the collection of checks that you are receiving and slow down the collection of checks that you are writing. So you want to delay as much as possible, cash outflows, and you want to really speed up the whole cash inflow process. And so float is basically just the difference between the balance shown in a company's checkbook, or basically what the balance of your cash is. And you want to make sure that you're trying to keep it as high as possible. And I've explained exactly how you can do so. And finally, another way to really improve your cash management is to speed up receipts. And basically what you can do is, making payments for customers, easy. And so you can basically, have systems in place where people can just sort of quickly wire the money, or they can pay online. So these are all methods of improving cash management. So this on this slide is an example of a cash budget. And so again, as I mentioned, companies need to plan. So here you can see that this company has planned their cash budget from July all the way to December. And here they're kind of really making all these, kind of accounts for, okay, this is how much sales money will be getting in cash. This is how many payments, this is our net cash flow, the net. And so here, I'm not going to go in too much detail. I'm not going to be asking you guys to build cash budgets, but I think it's very important for you to be very aware that, look, cash budgets are made by companies to really manage their cash flow situation. So if there's somebody in the company that's saying, look, we just need a lot of cash, well, that's not good enough. How much cash, for what purpose, and what is the forecast? And so this is an example of how cash budgets are developed to manage, the cash flow situation. Now, a working capital, management conversation won't really be complete until we also include a little bit of discussion around inventory. And again, the goal of inventory management is to ensure that inventory is available to sustain operations. You don't want too much inventory. You also don't want too little inventory. And holding cost of ordering and holding cost of ordering and holding inventory, you want to make sure that these costs are at the lowest level possible. So when you study supply chain management, there is a whole economic order of quantity that basically helps you understand exactly how much inventory needs to be held. But the main point is you want to make sure that you're holding the optimal amount where your total costs are the lowest. And the formula for calculating inventory is given over here. Inventory is equal to sales divided by inventory turnover ratio. And this formula is going to be important, for some of the questions that you will be solving for this chapter. So another integral part of working capital is accounts receivable. And here, a couple of things to mention is that, look, it's very important for companies to have, some sort of a credit policy, which basically means that, a certain duration during which your receivables need to be received, right? And after a certain point, it's too late for customers to pay and their order will be canceled. So it's important to have that kind of policy in place. And it's also important to also have a monitoring system to make sure that, okay, is everybody complying with the credit policy or not? And if not, then they need to be penalized in some way. As I mentioned, sometimes people actually go ahead and cancel the order. Now, every company really has different credit policies, but it is important for us to sort of touch a little bit on various types of credit policies that companies have. So what is a credit policy? Well, credit policy is the length of time buyers are given to pay for their purchase. So there are, you'll see many times terms such as 2/10 net 30. And this basically means that if a buyer pays within 10 days, then they will get a 2% discount. But they also have up to 30 days to pay. So 30 days, this 30 shows you have up to 30 days to pay. But if you pay within 10 days, you will get a 2% discount. And discounts, again, this is that 2% is how rapidly payments need to be paid to qualify for discounts. Next, I want to talk about credit standards, and this is the required financial strength of acceptable credit customers. So if you're going to be giving credit to a customer, many times they need to have a basic, decent level of credit standing. So they shouldn't be defaulters. If they're, defaulters, you may not want to necessarily be working with them. Also, I want to talk to you about the collection policy, and this is the toughness or how relaxed, the collection policy is. This is also something that I kind of just quickly wanted to share with you in terms of credit policy. Now, it is important for you to be able to calculate the cost of trade credit. And so here are some formulas. You will be needing these formulas again to solve some of the questions for this chapter. So the first thing is how do you calculate the nominal cost of trade credit? For this, you have a formula right over here, the discount percentage divided by 1 minus the discount percentage multiplied by 365 divided by the days credit is outstanding minus the discount rate. So in a situation, let's just look at this in an example, okay? That should make it clear for you. So in this example, the trade credit terms are 2/10, net 13. So if we want to convert this into a nominal cost of trade credit, we will take this 2. Okay, that's right here, the discount percentage. So 2% of the discount is being given. And we divide this by 100 minus the discount percentage, which again is 2. And then we multiply this by 365 right over here. And then we say, okay, the day's credit is outstanding. So we know that for 30, credit is being given for up to 30 days minus 10, which is the discount period, right? And this is right over here, 10. And so this gives in this, when plugged in to this specific trade credit term, that gives you 37.2%, which is the nominal cost of trade credit. Now, if we want to, so that's the nominal cost of trade credit, but if we want to calculate the effective annual rate, well, what we can do is, if you notice this term, 2 divided by 98 comes to 2.04%. And this term comes to 18.25%. So if we want to take the effective annual rate, we convert this into decimal points, add 1 to it. So that comes to 1.0204. And we take that to the power of 18.25, which is this right over here. And we subtract 1, and that will give us 44.6%. And some of your, again, the problems at the end of this chapter, you will be required to sort of use these formulas and to find nominal cost of trade credit and effective annual rates. All right, next I want to talk to you about the accumulation of receivables. And so basically, if you are really trying to find what the account receivable is, this is also the credit sale per day multiplied by the length of the collection period. A couple things to keep in mind. When a credit sale is made, then in that case, there are a series of things that happen. Number one, inventory decreases, account receivables increases, and the difference in profit, which is added to retained earnings. So there's a little typo over here, just, retained earnings. So difference in profit is added to retained earnings. So whatever, because a sale has been made, right? And so the profit need will be shown in your retained earnings. One thing to mention here that accruals is basically any amount of money that is withheld. And also there is something known as an aging schedule, which breaks down a firm's receivables by the age of the account. So just again, some terminologies for you regarding accumulation of receivables. Okay, also account payables are also known as trade credits. So this is something to keep in mind. Now also I want to talk to you a little bit about marketable securities. And marketable securities, basically, they give lower yields than operating assets can, and they can be converted to cash very, very quickly. So sometimes, companies invest in these investment policies of marketable securities. These are easy to liquidate. And so the good news is that you don't need to, this is a good way of raising, you convert it. So they're liquid. That's very good. That's one of the benefits. You don't need to issue securities to raise funds. So you can buy these securities rather easily. And, you can take advantage of growth opportunities. So if it's a little bit of speculation, right? But if you invest in marketable securities that have a good, they're increasing in their value, then you are, to a certain extent, taking advantage of the growth opportunities of those marketable securities, and you are benefiting. However, one thing to mention is that in general, because these marketable securities are highly liquid, the return on marketable securities is generally quite low. And finally, I want to talk to you about short-term financing. And these are basically short-term loans. And what are the benefits? Well, you don't need high flotation costs of the long-term debt. There are no prepayment provisions. It's less restrictive as compared to long-term financing. However, the disadvantage is that there may be several shifts in the interest rates. And so this can really add or increase your costs in certain situations. So that's a little bit of a disadvantage. And with that, we come to an end of working capital management. The key takeaway that I really want you to emphasize on is the cash conversion cycle, because that's very, very important. It's important for companies to be able to manage their cash requirements and above all their cash conversion cycle. And there's a whole offshoot of supply chain finance that really digs deeper into how working capital can be financed, how cash conversion cycles can be managed. So that's a whole separate topic, but something that I did want to bring to your knowledge. So thank you very much for your time. I hope you enjoyed this lecture, and I look forward to discussing this further with you in class.